Blockchain and Cryptocurrencies. Table of Content. Introduction. Chapter 1. The History of Money and Trust. Chapter 2. Understanding Blockchain Technology. Chapter 3. Cryptography Basics. Chapter 4. Decentralization. Chapter 5. Satoshi Nakamoto's Vision. Chapter 6. The Bitcoin Economy. Chapter 7. Ethereum and Smart Contracts. Chapter 8. Other Major Blockchains. Chapter 9. Decentralized Finance DeFi. Chapter 10. NFTs and the Creator Economy. Chapter 11. Decentralized Autonomous Organizations DAOs. Chapter 12. Web3 and the Future of the Internet. Chapter 13. Regulation and Legal Challenges. Chapter 14. Security, Privacy and Risks. Chapter 15. Scalability and Mass Adoption. Chapter 16. The Role of Institutions and Enterprises. Chapter 17. The Ethics and Philosophy of Decentralization. Chapter 18. Future Scenarios and Emerging Trends. Chapter 19. Summary and Final Reflections. Introduction. The world is undergoing a quiet revolution, one not led by governments, corporations, or armies, but by open-source code and cryptography. At the heart of this revolution lies blockchain technology and the sprawling ecosystem of cryptocurrencies it has enabled. What began as a 9-page white paper published under the pseudonym Satoshi Nakamoto in 2008 has grown into a multi-trillion-dollar industry that challenges our understanding of money, trust, and the Internet itself. This book is your guide to that revolution. Whether you are a curious newcomer or a seasoned technologist, understanding blockchain is no longer optional, it is essential. Financial institutions are adopting it, governments are regulating it, startups are building on it, and individuals around the world are using it to store value, send money, and build new forms of digital communities. Blockchain is no longer a fringe experiment, it is becoming infrastructure. Why blockchain matters? The invention of blockchain solved a problem computer scientists had grappled with for decades: how to create a trustless, decentralized system where participants can agree on a shared truth without a central authority. This breakthrough enables a wide range of applications. Digital money, cryptocurrency, a peer-to-peer monetary system outside the control of any single nation. Smart contracts, code that executes agreements automatically, enabling new forms of business and governance. Decentralized applications, DApps, platforms that run without centralized servers or intermediaries. Tokenization, representing anything of value, money, art, identity on a secure global ledger. The implications are profound. Blockchain challenges the role of banks, payment processors, and even governments. It opens up the possibility of an open, borderless financial system and a user-owned internet where individuals control their data and digital lives. The goal of this book. This book aims to provide a comprehensive, accessible, and forward-looking exploration of blockchain and cryptocurrencies. We will cover the history and mechanics of blockchain technology, the rise of Bitcoin, Ethereum, and thousands of altcoins, the explosive growth of DeFi, NFTs, DAOs, and Web3, the challenges of scalability, regulation, and security, the philosophical and ethical questions decentralization raises, the future scenarios that could shape the next decade of innovation. By the end of this book, you will have not only a deep understanding of how blockchain works, but also a critical perspective on its potential, its risks, and its societal implications. A journey into the future. We stand at the early stages of what may become one of the defining technological shifts of our century. Just as the Internet transformed how we communicate and access information, blockchain may transform how we exchange value, coordinate action, and govern society. This is more than a story about technology. It is a story about power, trust, freedom, and the future of human coordination. And it is a story that is still being written. Welcome to the world of blockchain and cryptocurrencies. Let's explore it together. Chapter 1: The History of Money and Trust. Human society has always depended on the exchange of value. In the earliest days, before the concept of money existed, communities relied on barter systems, trading goods and services directly. A hunter might trade meat for tools, or a farmer might exchange grain for clothing. While this worked in small groups, barter had a serious limitation known as the double coincidence of wants. For a trade to happen, each party had to want exactly what the other had at the same time and in the right quantity. The rise of money. To solve this inefficiency, societies began using commodity money, objects that held intrinsic value and were widely accepted in trade. Salt, cattle, shells, and precious metals all served as early forms of money. Metals like gold and silver became dominant because they were durable, easy to divide, and portable. The invention of coinage around 600 BCE in Lydia, modern-day Turkey, marked a major turning point. Coins standardized the value of money, making trade simpler and encouraging economic growth. The stamped seal on a coin served as a guarantee of its weight and purity, introducing a level of trust backed by a recognized authority. Centuries later, the Chinese pioneered paper money during the Tang and Song dynasties. Instead of carrying heavy coins, merchants used lightweight notes that represented stored value. This innovation gradually spread to Europe, eventually leading to the first banks and credit systems, where people could deposit their wealth and use promissory notes as claims. Trust and centralization. As banking systems grew, so did the centralization of trust. Gold and silver were stored in vaults, and paper notes became a claim on these reserves. People no longer had to trust individuals, they trusted institutions. This system worked well, but it created counterparty risk, the possibility that a bank could fail, be robbed, or refuse to honor withdrawals. By the 20th century, most nations abandoned the gold standard entirely and adopted fiat currency, money that has value because a government declares it legal tender. This shift allowed governments and central banks to manage monetary policy, stabilize economies, and respond to crises, but it also introduced new problems, such as inflation and the potential for political misuse of money creation. The digital era and new challenges. With the rise of computers and the internet, money went digital. Bank balances became just numbers in a database, and electronic payments replaced much of the cash economy. But this raised a new problem, the double spending problem. If digital money is just data, what prevents someone from copying it and spending it twice? Centralized systems like banks solve this by keeping ledgers, databases of who owns what, and verifying every transaction. But they remain single points of trust and potential failure. The search for digital cash. In the 1980s and 1990s, cryptographers and computer scientists experimented with creating a form of digital cash that didn't rely on a central authority. Projects like DigiCash, eGold, and Hashcash were promising but ultimately failed due to regulatory pressure, hacking incidents, or lack of adoption. Then in 2008, during the global financial crisis, an anonymous figure or group named Satoshi Nakamoto published the Bitcoin white paper, presenting a solution, a peer-to-peer electronic cash system that solved the double spending problem without relying on banks or governments. This was the birth of blockchain technology and the beginning of a new era of trustless money. Chapter 2: Understanding Blockchain Technology. Blockchain is one of the most significant technological breakthroughs of the 21st century, but it is often misunderstood. To appreciate its impact, we need to break it down into its fundamental components and see how they work together to create trust in a trustless environment. The core idea of blockchain. At its heart, a blockchain is a distributed ledger, a record of transactions shared across many computers, called nodes. Instead of one central database controlled by a bank, company, or government, every participant maintains a synchronized copy of the same ledger. When someone wants to add a transaction, the network must collectively agree that it is valid before it becomes part of the permanent record. This approach eliminates the need for a trusted middleman. Trust is shifted from centralized authorities to mathematics, cryptography, and consensus among participants. Blocks and chains. The name blockchain comes from the way data is stored. Transactions are bundled together into blocks. Each block contains a list of transactions, a timestamp, a cryptographic hash of the previous block. By linking each block to the one before it, we get a chronological chain of blocks. This design ensures that once a block is added, it is practically impossible to change it without redoing all the work for every subsequent block, making the ledger tamper-resistant. Key characteristics of blockchain. Blockchain technology has several defining features. Decentralization, no single point of control or failure. Transparency, anyone can view the ledger on public blockchains. Immutability, once recorded, data cannot easily be altered. Security, cryptographic techniques protect data integrity and user ownership. These qualities make blockchain attractive for applications where trust and verification are essential. Consensus mechanisms. In the absence of a central authority, blockchains rely on consensus mechanisms to ensure all participants agree on the state of the ledger. The two most widely used are proof of work (POW). Participants miners solve difficult mathematical puzzles. The first to solve it earns the right to add a block and is rewarded. This is secure, but energy-intensive. Proof of stake (POS). Validators are chosen to create blocks based on the amount of cryptocurrency they lock up as collateral, their stake. This is more energy efficient, but requires careful design to prevent attacks. Other mechanisms, like delegated proof of stake (DPoS) or practical Byzantine fault tolerance (PBFT), focus on speed and scalability but often sacrifice some decentralization. Public versus private blockchains. Not all blockchains are open to everyone. We can broadly classify them as public blockchains. Anyone can join, read, or write, e.g. Bitcoin, Ethereum. These are fully decentralized. Private blockchains. Access is restricted to approved participants, often used by corporations. Consortium hybrid blockchains. Controlled by a group of organizations, offering a balance of transparency and privacy. Why blockchain matters. Blockchain's innovation lies in creating a trustless system, one where participants can interact securely without knowing or trusting each other. This breakthrough has implications far beyond finance. Supply chains can be tracked end-to-end, digital identities can be secured, and organizations can operate transparently without central authorities. In the next chapter, we will explore the cryptographic building blocks that make blockchains secure, including hashing, public-private key pairs, and digital signatures. Chapter 3: Cryptography Basics. Blockchain would not be possible without cryptography, the science of protecting information. Cryptography gives blockchain its security, privacy, and trustless nature. To understand why blockchains are so resilient, we must first explore the cryptographic tools that make them work. What is cryptography? Cryptography is the art and science of using mathematical techniques to secure communication and data. Its main goals are confidentiality, ensuring information can only be read by intended recipients. Integrity, ensuring information cannot be altered without detection. Authentication, proving the origin of a message or transaction. Non-repudiation, preventing someone from denying that they sent a message or signed a transaction. Cryptographic hash functions. A hash function takes an input of any length and produces a fixed-length output called a hash or digest. This is one of the most fundamental tools in blockchain. Key properties of secure hash functions. Deterministic, the same input always yields the same output. Irreversible, it's infeasible to reverse engineer the input from the output. Collision resistant, It's extremely rare for two different inputs to produce the same output. Sensitive to input changes, even a single bit change in the input completely changes the hash. In blockchains, hashes are used to link blocks together, forming the chain. Verify data integrity without needing to trust a third party. Create unique identifiers for transactions. Bitcoin uses the SHA-256 hashing algorithm, which produces a 256-bit output. Public key cryptography. Blockchain transactions rely on public key cryptography, also called asymmetric cryptography. This system uses two mathematically related keys. Private key, known only to the user. It is used to sign transactions and prove ownership. Public key, shared openly. It allows others to verify that a signature is valid. This key pair allows users to send and receive funds securely without revealing their private keys. It is what makes it possible to prove ownership of digital assets without trusting a central authority. Digital signatures. Digital signatures are mathematical proofs that a message or transaction was created by someone holding a specific private key. In blockchains, a user signs a transaction with their private key. The network uses the public key to verify that the signature is valid. This ensures that only the rightful owner can authorize spending. Transactions cannot be forged. Transactions cannot be modified after being signed. Merkle trees and efficient verification. A blockchain block can contain thousands of transactions. To make verification efficient, blockchains use Merkle trees, a data structure that summarizes all transactions in a block with a single hash called the Merkle root. This allows nodes to verify individual transactions without downloading the entire block, making the network faster and more scalable. Zero-knowledge proofs and advanced cryptography. Modern blockchains are experimenting with zero-knowledge proofs, ZKPs, cryptographic techniques that allow someone to prove a statement is true without revealing the underlying data. For example, you could prove you own enough cryptocurrency to complete a transaction without disclosing your entire account balance. ZKPs are paving the way for privacy-preserving blockchains and more sophisticated applications. Why cryptography matters. Cryptography is what makes blockchain trustworthy. Without it, there would be no way to prevent fraud, no way to prove ownership, and no way to make the ledger immutable. The combination of hashing, digital signatures, and public key infrastructure creates a secure foundation that enables decentralized systems to function without a central authority. In the next chapter, we will look at decentralization, the principle that distributes power and trust across a network, removing single points of control. Chapter 4: Decentralization. Decentralization is one of the most important concepts in blockchain technology. It is the principle that removes single points of control and distributes decision-making power across a network. This shift changes how we build trust, share information, and interact online. Centralization versus decentralization. Most traditional systems are centralized. Banks hold our money, governments issue our currency, and corporations control our data. In a centralized system, a single authority manages the network. Users must trust that authority to act fairly and honestly. If the central authority fails, the entire system can be disrupted. Decentralization, by contrast, distributes power among many participants. No single person or organization has unilateral control. In a decentralized network, decisions are made collectively. The system can continue functioning even if some participants go offline. Trust is placed in code, cryptography, and consensus rather than individuals. The role of nodes. In a blockchain network, participants called nodes maintain a copy of the ledger. Each node verifies transactions independently, and all nodes work together to reach agreement on which transactions are valid. This makes the network resilient. Even if some nodes are compromised, the majority can reject fraudulent activity. Benefits of decentralization. Decentralization brings several key advantages. Censorship resistance. No single entity can block transactions or exclude users from participating. Fault tolerance. The network remains operational even if individual nodes fail. Transparency. Anyone can inspect the ledger, increasing accountability. Security. Attacking the network requires compromising a majority of participants, which is costly and impractical. These qualities make decentralized systems particularly attractive for financial applications, governance, and critical infrastructure. Trade-offs and challenges. Decentralization is not without its downsides. Distributing control often means slower decision-making. Reaching consensus takes time. Scalability challenges. Processing many transactions across many nodes can be resource-intensive. Complex governance. Disputes must be resolved through community processes, which can be contentious. Many blockchain projects experiment with different levels of decentralization to balance speed, cost, and security. Degrees of decentralization. It is important to recognize that decentralization exists on a spectrum. Some blockchains, like Bitcoin, are highly decentralized with thousands of independent nodes worldwide. Others are more centralized, with only a handful of validators or corporate participants. The level of decentralization affects security, trust, and resilience. Decentralization beyond blockchain. The principle of decentralization is spreading beyond cryptocurrencies. We see it in decentralized finance, DeFi, decentralized autonomous organizations, DAOs, decentralized storage systems, and even decentralized social networks. Together, these innovations form what is often called Web3, an internet owned and operated by its users rather than a few tech giants. Decentralization is the foundation that allows blockchain networks to be open, neutral, and resistant to censorship. In the next chapter, we will examine the first and most famous implementation of a decentralized blockchain system, Bitcoin. Chapter 5: Satoshi Nakamoto's Vision. The story of Bitcoin begins in 2008, during one of the most turbulent financial periods in modern history. The global financial crisis had shaken trust in banks, governments, and the entire economic system. It was against this backdrop that a mysterious figure or group, using the pseudonym Satoshi Nakamoto, released a short but revolutionary document, the Bitcoin White Paper. The Bitcoin White Paper. On October 31, 2008, Satoshi Nakamoto published a 9-page paper titled Bitcoin, a peer-to-peer electronic cash system on a cryptography mailing list. The paper proposed a way to transfer money directly between individuals without relying on banks or payment processors. Satoshi's idea was radical: a decentralized, trustless payment system where users could transact securely without an intermediary. The network would rely on mathematics, cryptography, and game theory, not on governments or corporations, to verify and secure transactions. Solving the double spending problem. The key innovation of Bitcoin was its solution to the double spending problem: how to prevent someone from spending the same digital token twice without a central authority keeping records. Satoshi's solution was a public blockchain maintained by participants around the world. Every transaction would be grouped into blocks, and blocks would be added to a chain through a process called mining. Once a block was confirmed, altering its transactions would require redoing the computational work for that block and every block after it, making fraud nearly impossible. Proof of work and mining. To secure the network, Bitcoin introduced proof of work, POW. In this system, miners compete to solve cryptographic puzzles. The first miner to solve the puzzle earns the right to add a new block to the chain. The miner is rewarded with newly created bitcoins and transaction fees. This mechanism incentivizes participants to act honestly. Attempting to cheat would require enormous amounts of computational power and energy, making attacks prohibitively expensive. The Genesis block. On January 3, 2009, Satoshi mined the very first block of the Bitcoin blockchain, known as the Genesis block or Block 0. Embedded in the block's code was a hidden message. The Times, the 3rd of January 2009, Chancellor, on brink of second bailout for banks. This message referenced a headline from the UK newspaper The Times and served as both a timestamp and a political statement. It hinted at Bitcoin's purpose, to create an alternative to the existing financial system. Early adoption and growth. In the early days, Bitcoin was mostly a curiosity among cryptographers and hobbyists. The first known commercial transaction happened in 2010, when a programmer named Laszlo Hanich famously paid 10,000 BTC for 2 pizzas, an event now celebrated every year as Bitcoin Pizza Day. Over time, more people joined the network, and Bitcoin's value began to rise. Communities formed around forums like Bitcoin Talk, where developers and enthusiasts discussed improvements, shared ideas, and debated the future of this new form of money. Satoshi's disappearance. In 2011, Satoshi Nakamoto gradually withdrew from public involvement, handing over control of the Bitcoin project to other developers. To this day, Satoshi's identity remains unknown. Whether an individual or a group, their decision to remain anonymous has only strengthened Bitcoin's decentralized ethos. No single person controls the network. Bitcoin was more than just a technical breakthrough. It was a philosophical statement about trust, freedom, and sovereignty over money. In the next chapter, we will explore how Bitcoin evolved from a niche experiment to a global financial phenomenon. Chapter 6: The Bitcoin Economy. With the creation of Bitcoin, the world had its first functional, decentralized digital currency. But Bitcoin was not just a technological breakthrough, it was the beginning of a new economy. Understanding the Bitcoin economy means exploring how people use it, how value is stored and transferred, and how its market dynamics work. Wallets and keys. Owning Bitcoin does not mean physically holding coins. Instead, it means having control of a private key, a cryptographic secret that proves ownership of the coins associated with a particular address on the blockchain. Bitcoin is stored in wallets, which can take several forms. Software wallets, apps for computers or smartphones that generate and store private keys. Hardware wallets, physical devices designed to store keys securely offline. Paper wallets, printed copies of public and private keys, offering a low-tech storage solution. The saying "not your keys, not your coins" is popular in the Bitcoin community. If you do not control the private keys to your wallet, you do not truly own the Bitcoin, which is why many prefer self-custody over leaving funds on exchanges. Exchanges and liquidity. Cryptocurrency exchanges allow people to buy, sell, and trade Bitcoin for other currencies. Early exchanges like Mt. Gox played a crucial role in Bitcoin's growth, but also exposed users to new risks. When Mt. Gox collapsed in 2014 due to a massive hack, it highlighted the dangers of centralized custody and drove demand for more secure platforms. Today, exchanges range from centralized platforms like Coinbase, Binance, and Kraken to decentralized exchanges (DEXs), where users trade directly from their own wallets. Price volatility and market cycles. Bitcoin's price history has been marked by dramatic cycles of boom and bust. Rapid price increases attract media attention and new investors. Speculative bubbles form, followed by steep corrections. Each cycle, however, has tended to end with Bitcoin at a higher price floor than before. This volatility is partly due to Bitcoin's fixed supply, only 21 million will ever exist, and its relatively small market size compared to traditional asset classes. As adoption grows, many expect price swings to become less extreme. Use cases for Bitcoin. Bitcoin was designed as peer-to-peer electronic cash, but over time it has evolved into multiple roles. Store of value, often called digital gold, Bitcoin is used as a hedge against inflation and currency devaluation. Medium of exchange. Some merchants accept Bitcoin for payments, especially in countries with unstable currencies. Remittances. Bitcoin allows fast, low-cost cross-border transfers without traditional banking infrastructure. Speculation and investment. Many buy Bitcoin as an asset, hoping its price will rise. The network effect. Bitcoin's strength grows as more people use and support it, a phenomenon known as the network effect. More participants mean more security, because more miners secure the network. More liquidity, because there are more buyers and sellers. Greater legitimacy and mainstream acceptance. Challenges and criticisms. Despite its success, Bitcoin faces challenges. Scalability. The network can only handle a limited number of transactions per second. Energy use. Proof of work consumes significant electricity, sparking debates about sustainability. Regulatory uncertainty. Governments are still deciding how to classify and regulate Bitcoin. Solutions like the Lightning Network, a Layer 2 payment channel system, aim to address scalability by enabling faster and cheaper transactions. Bitcoin has grown from an obscure experiment to a global financial asset, with a market capitalization in the hundreds of billions. In the next chapter, we will explore the rise of Ethereum and how it expanded the possibilities of blockchain technology beyond money. Chapter 7: Ethereum and Smart Contracts. While Bitcoin introduced the world to decentralized money, it was Ethereum that expanded blockchain's potential far beyond currency. Launched in 2015 by a young developer named Vitalik Buterin and a team of co-founders, Ethereum was designed to be a platform for decentralized applications, not just payments. The vision of Ethereum. Ethereum was created to answer a simple question: what if blockchain could do more than record transactions? What if it could run code in a decentralized, tamper-proof way? The answer was a Turing-complete blockchain capable of executing general-purpose programs called smart contracts. These contracts could handle complex logic, making Ethereum a world computer where anyone could deploy applications that run exactly as written without downtime, censorship, or interference. Smart contracts explained. A smart contract is a self-executing program stored on the blockchain. It automatically carries out its terms when predefined conditions are met. For example, an insurance contract could automatically pay out when a flight is delayed. A crowdfunding campaign could return funds to donors if the funding goal is not met. Smart contracts remove the need for trusted intermediaries. The code itself enforces the rules. Ethereum's architecture. Ethereum shares many similarities with Bitcoin, but includes key differences. Ethereum Virtual Machine (EVM), a decentralized computing environment where smart contracts are executed. Gas, a fee users pay to run computations, preventing spam and allocating network resources. Account types. Ethereum supports externally owned accounts controlled by private keys and contract accounts controlled by code. These innovations transformed Ethereum into a flexible platform for innovation. ERC standards and tokenization. Ethereum's versatility led to the creation of token standards like ERC20, which defines how fungible tokens, cryptocurrencies built on Ethereum, behave. This standard enabled thousands of projects to issue their own tokens easily, fueling the initial coin offering (ICO) boom of 2017. Another standard, ERC 721, introduced non-fungible tokens, NFTs, unique digital assets used for art, collectibles, and gaming. The power of decentralized applications, DApps. Developers quickly began building decentralized applications on Ethereum, including decentralized exchanges, DEXs, like Uniswap, enabling peer-to-peer token swaps. DeFi protocols, lending, borrowing, and yield farming without banks. NFT marketplaces, platforms like OpenSea for buying and selling digital collectibles. DAO governance tools, enabling communities to make collective decisions transparently. Challenges and evolution. Ethereum's popularity has also exposed its limitations. Scalability issues. High demand leads to network congestion and expensive gas fees. Energy use. Until recently, Ethereum relied on proof of work like Bitcoin. In 2022, Ethereum transitioned to proof of stake in an upgrade known as the merge, reducing energy usage by over 99% and setting the stage for future scalability improvements through sharding and Layer 2 solutions. Why Ethereum matters. Ethereum demonstrated that blockchains could be more than ledgers. They could be programmable platforms for an entire decentralized economy. This innovation opened the door to decentralized finance, NFTs, DAOs, and more, laying the foundation for what we now call Web3. In the next chapter, we will look beyond Ethereum to explore other major blockchain platforms and how they attempt to solve problems like scalability, interoperability, and speed. Chapter 8: Other major blockchains. Ethereum may have been the first blockchain to introduce smart contracts, but it is no longer the only platform competing for developers, users, and innovation. A new generation of blockchains has emerged, each attempting to address Ethereum's limitations in scalability, speed, and cost. The need for alternatives. Ethereum's success came with growing pains. High demand led to network congestion and expensive transaction fees, making some applications impractical for everyday users. This opened the door for Layer 1 competitors, blockchains that offer smart contract functionality with improved performance. Solana, high-speed transactions. Solana is known for its high throughput, capable of processing thousands of transactions per second, TPS, with very low fees. It achieves this using Proof of History (POH), a cryptographic clock that orders transactions efficiently. Parallel processing, allowing transactions to be validated simultaneously. Solana has become popular for DeFi and NFT projects that require fast and inexpensive transactions. However, critics note that its architecture sacrifices some decentralization for performance, and the network has faced occasional outages. Cardano, research-first approach. Cardano, founded by Ethereum co-founder Charles Hoskinson, takes a more academic and peer-reviewed approach to blockchain development. It uses Ouroboros proof of stake, a consensus mechanism designed for security and energy efficiency. Layered architecture, separating settlement and computation layers for scalability. Cardano has focused heavily on formal methods and gradual rollout of features, leading to a reputation for scientific rigor but also slower development compared to competitors. Polkadot and interoperability. Polkadot aims to create an internet of blockchains. Instead of being a single chain, Polkadot is a network of multiple blockchains called parachains that can communicate with one another through the relay chain. This design enables interoperability. Different blockchains can exchange data and assets. Specialization. Each parachain can be optimized for a specific use case. Shared security. Parachains inherit security from the relay chain. Avalanche. Speed and customization. Avalanche focuses on both scalability and flexibility. It allows developers to create their own custom blockchains, subnets, that interoperate within the Avalanche ecosystem. Its consensus mechanism enables near-instant transaction finality. Other notable players. Binance Smart Chain (BSC), known for low fees and compatibility with Ethereum's ecosystem but criticized for centralization. Near Protocol offers sharding-based scalability and a developer-friendly environment. Algorand, focused on fast finality and simple smart contract deployment. The Layer 2 revolution. In addition to new Layer 1 blockchains, Layer 2 solutions are emerging to scale Ethereum itself. These include Roll-ups, bundling many transactions into one to reduce costs, e.g. Optimism Arbitrum ZKSYNC. State channels, enabling off-chain transactions that settle on-chain only when necessary. Layer 2s are allowing Ethereum to stay competitive while retaining its decentralization and security. The multi-chain future. It is increasingly likely that no single blockchain will dominate. Instead, we may see a multi-chain ecosystem where different platforms specialize in different tasks: high-speed trading, privacy-focused applications, enterprise solutions, and so on. Interoperability protocols and bridges will allow users to move assets seamlessly across chains, making blockchain technology more connected and user-friendly. In the next chapter, we will explore the rise of decentralized finance, DeFi, one of the most powerful use cases driving adoption across many of these blockchains. Chapter 9: Decentralized Finance, DeFi. Decentralized finance, or DeFi, is one of the most transformative movements to emerge from blockchain technology. It represents a parallel financial system, open, permissionless, and accessible to anyone with an internet connection. The birth of DeFi. While Ethereum provided the foundation for decentralized applications, DeFi as a concept truly took off around 2018 to 2020. Early projects like MakerDAO, Uniswap, and Compound laid the groundwork for what became known as DeFi Summer, a period of explosive growth in decentralized financial products. Core principles of DeFi. DeFi seeks to recreate and improve traditional financial services by using smart contracts instead of intermediaries. Its core principles include permissionless access, no bank account or approval required, just a wallet. Transparency, all transactions and contract code are publicly visible on the blockchain. Interoperability, applications can interact with one another like building blocks, money Legos. Self-custody, users retain control of their funds without relying on a centralized custodian. Key DeFi applications. Decentralized exchanges, DEXs. DEXs like Uniswap, SushiSwap, and Curve allow users to trade tokens directly from their wallets. Instead of using order books, many rely on automated market makers, AMMs, that use liquidity pools to facilitate trades. Lending and borrowing. Protocols like Aave and Compound enable users to lend out their crypto and earn interest, or borrow assets by locking collateral into a smart contract. These systems run automatically, setting interest rates algorithmically. Stablecoins. Stablecoins like DAI, USDC, and USDT are crucial to DeFi. They provide price stability by pegging their value to a fiat currency, usually USD, allowing users to transact without worrying about volatility. Yield farming and liquidity mining. DeFi users can earn rewards by providing liquidity to protocols or staking assets. This process, known as yield farming, became a major driver of capital inflows during DeFi Summer. Synthetic assets and derivatives. Platforms like Synthetic allow users to create tokenized versions of real-world assets, such as stocks, commodities, and currencies, and trade them in a decentralized way. DeFi risks. While DeFi offers many opportunities, it is not without dangers. Smart contract bugs, flaws in code can be exploited by hackers, leading to massive losses. Impermanent loss. Liquidity providers can lose value when token prices fluctuate. Rug pulls and scams. Malicious developers can drain funds from users. Regulatory uncertainty. Governments are still deciding how to oversee DeFi activities. The future of DeFi. DeFi is still in its early stages, but its potential is enormous. Future developments may include more scalable infrastructure. Layer 2 solutions and cross-chain DeFi protocols will reduce costs and improve speed. Integration with traditional finance. Banks and institutions may use DeFi protocols under regulated frameworks. Decentralized identity and credit scoring, making lending more accessible without sacrificing privacy. Why DeFi matters. DeFi democratizes access to financial services. Billions of people around the world remain unbanked, but with DeFi, anyone can lend, borrow, trade, and invest without requiring permission from a centralized institution. In the next chapter, we will explore NFTs and the creator economy, where blockchain technology is empowering artists, musicians, and creators to monetize their work in new ways. Chapter 10: NFTs and the creator economy. Non-fungible tokens, NFTs, represent one of the most exciting and controversial innovations in blockchain technology. Unlike cryptocurrencies, which are fungible and interchangeable, NFTs are unique digital assets that prove ownership of a specific item, piece of media, or data on the blockchain. Understanding NFTs. An NFT is essentially a token that contains metadata pointing to a unique asset. This asset might be a digital artwork, a music file or album, a collectible trading card, a video clip or meme, a ticket to an event. The token serves as proof of authenticity and ownership, verifiable on a public blockchain. The most common standard for NFTs is ERC-721 on Ethereum. The NFT boom. NFTs exploded into mainstream awareness in 2021 when high-profile sales made headlines. Digital artist Beeple sold an NFT artwork for $69 million at Christie's. Collections like CryptoPunks and Bored Ape Yacht Club became cultural phenomena. Celebrities, brands, and musicians began experimenting with NFT drops. NFT marketplaces such as OpenSea, Rarible, and Foundation emerged as central hubs for buying, selling, and trading NFTs. The creator economy. NFTs have transformed the creator economy by enabling artists and creators to sell work directly to fans without intermediaries, program royalties into NFTs so they earn a percentage every time the asset is resold, build engaged communities around collections, granting holders special access or benefits. This direct-to-fan model gives creators more control over their intellectual property and monetization. Use cases beyond art. While NFTs are best known for digital art, their use cases are expanding rapidly. Gaming. In-game items, skins, and characters can be tokenized and traded across marketplaces. Music and film. Artists can release limited edition albums or tickets as NFTs. Virtual real estate. Platforms like Decentraland and The Sandbox sell virtual land parcels as NFTs. Identity and certification. NFTs can represent academic credentials, memberships, or licenses. Challenges and criticism. Despite their promise, NFTs face significant challenges. Environmental concerns. Early NFTs were criticized for their carbon footprint due to proof-of-work blockchains. Speculation. Many see NFTs as a bubble driven by hype rather than intrinsic value. Intellectual property issues. Cases of stolen art and unauthorized minting have raised questions about copyright enforcement. The future of NFTs. The NFT space is rapidly evolving toward utility-driven NFTs, focused on functionality, e.g., membership passes, token-gated experiences, rather than speculation. Cross-chain interoperability. NFTs that can move across multiple blockchains. Integration with Web3 and Metaverse, allowing NFTs to serve as avatars, game assets, and identity layers in virtual worlds. Why NFTs matter. NFTs are pioneering a new way of thinking about digital ownership. For the first time, scarcity and provenance can be applied to digital goods, creating new business models and reshaping how we value creativity. In the next chapter, we will explore decentralized autonomous organizations, DAOs, the governance layer of Web3 that enables communities to organize and make decisions collectively. Chapter 11. Decentralized Autonomous Organizations, DAOs. As blockchain technology evolved, it became clear that decentralized networks needed new ways to coordinate and govern themselves. Enter decentralized autonomous organizations, DAOs, a new model for collective decision-making powered by smart contracts. What is a DAO? A DAO is a digital organization that operates transparently on a blockchain and is collectively owned by its members. Rules are encoded in smart contracts, and decisions are made through voting mechanisms rather than centralized leadership. Key characteristics of a DAO include decentralization. No single party controls the organization. Autonomy. Smart contracts execute rules automatically once certain conditions are met. Transparency. All proposals, votes, and transactions are publicly visible on-chain. The first DAO. In 2016, a project simply called The DAO was launched on Ethereum. It was a decentralized venture fund where token holders could vote on which projects to fund. However, a vulnerability in its smart contract was exploited, resulting in a major hack that drained millions of dollars worth of ETH. This event led to a controversial Ethereum hard fork, splitting the network into Ethereum, ETH, and Ethereum Classic, etc. Despite the setback, the idea of DAOs continued to evolve. How DAOs work. Most DAOs follow a similar governance structure. Token distribution. Members hold governance tokens representing voting power. Proposal submission. Anyone can submit proposals for changes, funding, or actions. Voting. Token holders vote with their influence proportional to the tokens they hold. Execution. If a proposal passes, smart contracts automatically execute the decision. Types of DAOs. DAOs have expanded into many categories. Protocol DAOs govern major DeFi platforms like Uniswap, Aave, and MakerDAO. Investment DAOs pool funds to invest in projects or NFTs. Social DAOs focus on community building and shared values, e.g., friends with benefits. Collector DAOs acquire and curate valuable NFTs or digital art. Grant DAOs distribute funds to support public goods or ecosystem development. Benefits of DAOs. Global participation. Anyone, anywhere can join and have a voice. Aligned incentives. Token holders are incentivized to make decisions that benefit the network. Transparency. Reduces corruption and hidden decision-making. Challenges facing DAOs. While promising, DAOs are still experimental and face several hurdles. Low voter participation. Many members fail to vote, leading to governance apathy. Plutocracy risk. Wealthy token holders can dominate decisions. Legal uncertainty. The legal status of DAOs is still undefined in many jurisdictions. Security risks. Smart contract vulnerabilities can lead to exploits. The future of DAOs. DAOs are likely to play a critical role in the evolution of Web3. We may see more sophisticated governance models, quadratic voting, reputation-based systems, and delegated voting. Legal recognition. Jurisdictions like Wyoming have started recognizing DAOs as legal entities. Integration with real-world organizations. DAOs could eventually manage companies, cities, or even nations. Why DAOs matter. DAOs represent a new frontier in human coordination, a way to organize resources and make decisions collectively without relying on centralized authorities. They are testing grounds for the future of democracy, economics, and organizational design. In the next chapter, we will dive into Web3 and the future of the Internet, where DAOs, NFTs, DeFi, and decentralized identity converge to form a new digital paradigm. Chapter 12: Web3 and the Future of the Internet. The term Web3 has become a catch-all phrase for the next generation of the Internet, one that is decentralized, user-owned, and powered by blockchain technology. Web3 aims to address the shortcomings of today's web by returning control of data, identity, and value to individuals. From Web 1 to Web 3. To understand Web 3, it helps to trace the evolution of the Internet. Web 1, 1990s, early 2000s, the read-only web. Static websites where users consumed content but had limited interaction. Web 2, 2000s, present, the read-write web. Social media, user-generated content, and platforms like Facebook and YouTube allowed anyone to publish, but centralized corporations owned the infrastructure and monetized user data. Web 3 emerging, the read-write-own web. Users interact and create content but also own their data, digital assets, and identities through decentralized technologies. Key components of Web 3. Web 3 is not a single technology, but a collection of protocols and tools working together. Blockchain networks, the backbone of Web 3, providing decentralized data storage and consensus. Cryptocurrencies and tokens, native assets that power transactions and incentivize network participation. Decentralized identity, DID, systems allowing users to control their own digital identity without relying on centralized logins. Smart contracts, automating trust and enabling decentralized applications. Storage solutions, protocols like IPFS and Arweave store files in a distributed way. Interoperability protocols, bridges and cross-chain solutions that allow assets and data to flow across networks. Advantages of Web 3. Web 3 promises a more equitable digital future. Data ownership, users control their personal data and choose how it's shared. Censorship resistance, no single authority can easily take down content or block transactions. Open access, anyone with an internet connection can participate. Native payments, cryptocurrencies allow for seamless global transactions. Challenges and criticisms. Web 3 is still young and faces significant hurdles. User experience, managing private keys and interacting with DApps can be intimidating. Scalability, high gas fees and slow transaction speeds hinder mass adoption. Centralization risks, many Web 3 projects still rely on centralized infrastructure, e.g. servers, front ends. Regulatory pressure, governments are exploring how to regulate decentralized systems. Web 3 use cases. Web 3 enables a wide range of possibilities. Decentralized social media, platforms where users own their content and monetize directly. Play-to-earn gaming, games like Axie Infinity where players earn tokens for participation. Creator economies, NFTs and token-gated communities empowering creators to monetize their work. Decentralized finance, lending, trading, and investing without banks. The metaverse and Web 3. The concept of the metaverse, a persistent shared digital world, is closely tied to Web 3. NFTs represent digital land and assets, cryptocurrencies enable commerce, and DAOs govern virtual communities. The future outlook. If successful, Web 3 could lead to a more open internet, controlled by protocols, not corporations. New economic models, tokenized networks where users are stakeholders. Global financial inclusion, billions gaining access to digital assets and services. However, it is equally possible that Web 3 will evolve in hybrid forms, blending decentralization with practical usability improvements to meet mainstream needs. Why Web 3 matters. Web 3 is more than a buzzword, it represents a paradigm shift in how humans interact online. It challenges the dominance of centralized platforms and offers a vision of an internet where users have sovereignty over their data, identity, and digital wealth. In the next chapter, we will examine regulation and legal challenges, exploring how governments and institutions are responding to blockchain, cryptocurrencies, and the decentralized internet. Chapter 13: Regulation and Legal Challenges. As blockchain and cryptocurrency adoption grows, governments and regulators are paying closer attention. The clash between decentralization and traditional legal systems has created one of the most significant debates of the digital age. The regulatory landscape. Blockchain technology is inherently borderless, but regulation is jurisdiction-specific. Different regions have taken different approaches. United States: the U.S. treats cryptocurrencies as commodities, CFTC, or securities, SEC, depending on the token. Tax authorities, IRS, classify them as property, subject to capital gains tax. European Union: the EU is rolling out the MiCA, Markets in Crypto Assets framework, to create standardized rules for crypto companies. Asia: countries vary widely. Japan regulates exchanges, Singapore fosters innovation, while China has banned most crypto trading. Key regulatory issues. Securities laws. One major question is whether certain tokens are considered securities. If so, they must comply with strict registration and disclosure requirements. This has led to legal battles over whether tokens like XRP are unregistered securities. Anti-money laundering, AML, and KYC. Regulators require crypto exchanges to implement Know Your Customer, KYC, and anti-money laundering, AML measures to prevent illicit finance. This creates tension with privacy-focused users who value anonymity. Taxation. Cryptocurrency transactions are taxable events in many jurisdictions. This includes capital gains from selling or trading crypto, mining and staking rewards as income, stablecoin oversight. Stablecoins have drawn attention from central banks and regulators due to their potential impact on monetary policy. Proposals include requiring issuers to hold reserves and undergo audits. DeFi and DAOs. Regulators face new challenges with DeFi protocols and DAOs, which often lack a central entity to regulate. Questions arise. Who is responsible if a protocol is hacked? How can compliance be enforced in a permissionless system? Global coordination challenges. Because crypto is global, inconsistent regulations can lead to regulatory arbitrage, where companies relocate to friendlier jurisdictions. This creates pressure for international cooperation, but aligning policies across nations is complex. Central bank digital currencies, CBDCs. In response to crypto's rise, many governments are exploring CBDCs, digital versions of national currencies. These could coexist with cryptocurrencies but raise privacy concerns since they may give governments greater oversight of transactions. Legal innovations. Some regions are experimenting with legal frameworks to embrace blockchain. Wyoming, USA, legally recognizes DAOs as LLCs. Switzerland's Crypto Valley offers clear regulatory guidelines for blockchain startups. El Salvador made Bitcoin legal tender, a world-first move that inspired both excitement and criticism. Balancing innovation and protection. The challenge for regulators is to strike a balance between encouraging innovation and protecting consumers, investors, and financial stability. Overregulation could stifle innovation, while underregulation could enable fraud and systemic risks. The road ahead. As crypto matures, we are likely to see clearer definitions of digital assets, regulatory frameworks tailored for DeFi, NFTs, and DAOs, greater collaboration between governments and blockchain projects. Why regulation matters. Regulation will play a decisive role in determining the future of blockchain technology. The right balance could foster trust, encourage institutional adoption, and integrate crypto into the global economy. Poorly designed rules, however, could push innovation underground or offshore. In the next chapter, we will explore security, privacy, and risks, crucial considerations for anyone participating in the blockchain ecosystem. Chapter 14: Security, Privacy, and Risks. Blockchain technology is often described as secure and tamper-resistant, and while that is true at the protocol level, there are still many risks for users, developers, and investors. Understanding these risks is critical to navigating the crypto ecosystem safely. Blockchain security basics. Public blockchains use cryptography, decentralization, and consensus mechanisms to secure data. However, vulnerabilities can arise in three main areas: the blockchain protocol, bugs or weaknesses in the underlying code; smart contracts, logic flaws that attackers can exploit; user practices, poor key management or phishing attacks leading to stolen funds. Common security risks. 51% attacks. If a single entity controls more than 50% of a network's mining or staking power, they could theoretically rewrite transactions and double-spend coins. This is rare on large networks like Bitcoin, but has occurred on smaller blockchains. Smart contract exploits. Smart contracts are immutable once deployed, so vulnerabilities can be catastrophic. High-profile hacks, such as the DAO exploit and various DeFi protocol breaches, have resulted in losses of hundreds of millions of dollars. Exchange hacks. Centralized exchanges are attractive targets for hackers. Famous cases like the Mt. Gox collapse and Coincheck hack highlight the risk of leaving funds in custodial wallets. Phishing and social engineering. Many attacks don't exploit blockchain itself, but rather trick users into giving up their private keys, seed phrases, or signing malicious transactions. Rug pulls and scams. In DeFi and NFT markets, malicious developers can launch projects, attract liquidity, and then drain funds, leaving investors with worthless tokens. Privacy concerns. While Bitcoin and most public blockchains are pseudonymous, they are not fully private. Every transaction is visible on the ledger, which can allow blockchain analysis. Companies can trace funds and link them to real-world identities. Loss of financial privacy. Spending habits can be exposed. Privacy-focused cryptocurrencies like Monero and Zcash address these issues with technologies like ring signatures and ZK snarks. Best practices for users. Self-custody. Use hardware wallets and keep private keys offline. Secure your seed phrase. Store backups in multiple safe locations. Be wary of links. Always verify websites and smart contracts before interacting. Use multi-factor authentication for any exchange accounts. Best practices for developers. Code audits. Have independent security firms audit smart contracts. Bug bounties. Incentivize security researchers to report vulnerabilities. Upgrade paths. Design contracts with upgradability when appropriate. Insurance and risk mitigation. The crypto space has seen the emergence of DeFi insurance protocols like Nexus Mutual, which allow users to protect against smart contract failures and exchange hacks. The human factor. Ultimately, the biggest risk often comes from human error. Losing a private key means losing access to funds forever, as there is no forgot password button in blockchain systems. Why security and privacy matter. Trust is the foundation of any financial system. For blockchain to achieve mainstream adoption, users must feel confident that their assets are safe and their privacy respected. In the next chapter, we will explore scalability and the quest for mass adoption, looking at how blockchain networks are evolving to support millions or billions of users. Chapter 15: Scalability and Mass Adoption. Blockchain technology has proven its potential, but achieving mass adoption requires solving one of its biggest challenges: scalability. The current generation of blockchains often struggles to handle the transaction volume required for mainstream use. The scalability trilemma. Ethereum co-founder Vitalik Buterin famously described the scalability trilemma, which states that blockchains can optimize for only two of the following three at any given time. Decentralization, maximizing the number of participants who can run a node. Security, ensuring the network is resistant to attacks. Scalability, supporting a high throughput of transactions. Most blockchains prioritize decentralization and security, resulting in slower speeds and higher fees. The challenge is finding solutions that improve scalability without sacrificing trustlessness. Layer 1 solutions. Layer 1 refers to improvements made directly on the base blockchain. Examples include sharding, breaking the network into smaller pieces, shards that process transactions in parallel. Ethereum plans to implement this in future upgrades. Alternative consensus mechanisms, moving from energy-intensive proof of work to faster, more efficient proof-of-stake systems. Optimize block sizes, increasing block size or block frequency as seen in Bitcoin Cash and other forks. Layer 2 solutions. Layer 2 solutions build on top of existing blockchains to increase throughput. Rollups bundle many transactions into a single proof that is submitted to the base chain. Examples include optimistic rollups, Optimism Arbitrum, and ZK rollups, ZKSYNC Starknet. Payment channels, off-chain channels like the Bitcoin Lightning Network enable instant low-fee payments. Sidechains, independent blockchains that run in parallel and connect to the main chain, e.g., Polygon for Ethereum. Interoperability and cross-chain bridges. As multiple blockchains emerge, interoperability becomes crucial. Bridges allow assets and data to move across networks, creating a more connected ecosystem. However, they also introduce new security risks and have been frequent targets for hacks. User experience challenges. For mass adoption, blockchain must be as easy to use as existing financial apps. Challenges include key management. Non-technical users struggle with private key security. Complex UX. Wallets and DApps can be confusing for beginners. Onboarding. Buying crypto often requires lengthy KYC processes. Projects are working on solutions like account abstraction, social recovery wallets, and more intuitive interfaces. Real-world adoption drivers. Scalability improvements are crucial for global payments, competing with Visa-level throughput. Gaming and NFTs, supporting millions of microtransactions. Enterprise use cases, allowing corporations to use blockchain for supply chains, identity, and data management. Measuring success. Key metrics to watch as we move toward mass adoption include number of active users and wallets, daily transaction volume and fees, integration with traditional finance, banks, payment apps, regulatory clarity, and institutional participation. The path forward. Scalability will not be solved by one single solution, but by a combination of Layer 1 and Layer 2 innovations, interoperability protocols, and better user experience. The future may be a modular blockchain ecosystem where different components handle execution, settlement, and data availability. In the next chapter, we will explore the role of institutions and enterprises, examining how traditional finance, corporations, and governments are engaging with blockchain and crypto technologies. Chapter 16: The Role of Institutions and Enterprises. In the early days of cryptocurrency, Bitcoin was viewed as a tool for individuals seeking financial sovereignty outside of traditional systems. Over time, institutions and large corporations have begun to play a critical role in legitimizing and accelerating the adoption of blockchain technology. Institutional adoption of crypto. Early pioneers. The first wave of institutional involvement came from hedge funds and venture capital firms experimenting with Bitcoin as a speculative asset. Over time, the following major players joined. Publicly traded companies, Tesla, MicroStrategy, and Square Block, added Bitcoin to their balance sheets. Payment processors, PayPal and Stripe enabled crypto transactions for millions of users. Banks, JP Morgan, Goldman Sachs, and others launched crypto trading desks or custody services. Institutional investment vehicles. The creation of products like Bitcoin futures, ETFs, and trusts, e.g., Grayscale Bitcoin Trust, made crypto more accessible to institutional investors who cannot hold digital assets directly. Enterprise use cases. Corporations are exploring blockchain beyond cryptocurrencies. Common enterprise use cases include Supply chain management. IBM Food Trust and VChain track goods from production to delivery. Trade finance. Streamlining cross-border transactions with smart contracts. Identity verification. Decentralized identity systems reduce fraud and streamline onboarding. Tokenization. Converting real-world assets, real estate, stocks, art into blockchain-based tokens. Central banks and governments. Governments are increasingly experimenting with blockchain technology. Central bank digital currencies, CBDCs. China's digital yuan and pilot projects in Europe and the US aim to modernize payments. Blockchain for public services. Land registry, voting systems, and transparent budgeting are being explored. Regulatory frameworks. Governments are working to create legal clarity for crypto markets, which indirectly boosts adoption. Benefits for institutions. Efficiency. Lower settlement times and costs for payments and asset transfers. Transparency. Immutable records enhance trust and compliance. New revenue streams. Financial products and services built on tokenized assets. Customer demand. Younger generations increasingly expect digital asset offerings. Challenges for enterprises. Regulatory uncertainty. Compliance is complex and varies by jurisdiction. Security concerns. Large-scale custody requires robust protection against hacks. Integration costs. Legacy systems must be upgraded or rebuilt to integrate blockchain. Volatility. Price swings in crypto assets can affect corporate treasuries. The institutional impact on crypto. While institutional involvement brings legitimacy, it also raises concerns. Centralization risk. Large players can accumulate significant influence over networks. Regulatory capture. Institutions may lobby for rules that favor them over retail users. Shift in culture. Crypto's cypherpunk ethos may be diluted as mainstream adoption grows. The future of enterprise blockchain. We can expect continued convergence between traditional finance and crypto. Trends include tokenized securities, stocks and bonds traded on blockchain platforms. Hybrid infrastructure, private and public blockchains working together. Corporate DAOs, businesses experimenting with decentralized governance. Why institutional participation matters. Institutions and enterprises have the power to bring blockchain technology to billions of users. Their participation can accelerate adoption, drive regulatory clarity, and unlock new markets, provided they respect the open, decentralized nature of the technology. In the next chapter, we will explore the ethics and philosophy of decentralization, diving into the ideological roots of blockchain and what it means for society's future. Chapter 17: The Ethics and Philosophy of Decentralization. At its core, blockchain is more than just a technology, it is a philosophical movement. The idea of decentralization challenges long-standing assumptions about power, trust, and the way human societies organize themselves. The ideological roots. Blockchain's philosophical foundation draws from several key traditions. Cypherpunk ethos, advocating for privacy, cryptography, and self-sovereignty in the digital age. Libertarian economics, a belief in minimizing state control and empowering free markets. Open source principles, knowledge and code should be transparent and accessible to all. Bitcoin's white paper was published in 2008, in the shadow of the global financial crisis, a moment when trust in banks and governments was shaken. This context fueled the idea of a money system beyond centralized control. The ethics of trustlessness. One of blockchain's most profound contributions is the concept of trustless systems, networks where participants do not need to trust each other or a central authority. Instead, trust is placed in mathematics. Cryptography ensures security. Code, smart contracts enforce rules automatically. Consensus, distributed nodes agree on a single source of truth. This raises ethical questions. Should we seek to eliminate trust, or to build better systems of trust? Does automation reduce human accountability? Decentralization and power. Decentralization aims to distribute power, but achieving true decentralization is complex. Mining concentration. Bitcoin mining is dominated by a few large pools. Governance participation. Low voter turnout in DAOs can centralize power in a small minority. Infrastructure dependence. Many DApps rely on centralized servers or APIs. This creates a tension between decentralization as an ideal and practical implementation. Ethical questions in crypto. Financial inclusion versus speculation. Does crypto empower the unbanked or just enrich early adopters? Environmental impact. Proof of work mining consumes significant energy. Is it ethically justifiable? Censorship resistance versus harmful content. A censorship-resistant network could also host illegal or harmful data. Token distribution. Fair launches versus pre-mines raise questions of equity. Philosophical implications. Decentralization is not just about money, it is about rethinking how humans coordinate. Governance. Could DAOs become a model for digital democracy? Identity. Decentralized identity could shift control of personal data back to individuals. Value creation. Tokenized economies could reward contributors in ways traditional corporations cannot. Balancing ideals with reality. Many in the crypto community believe that decentralization is a spectrum, not an absolute state. The goal is to find the right balance between efficiency and resilience. Fully decentralized systems may be slower and harder to upgrade. Privacy and compliance. Users demand privacy, but governments require oversight. Freedom and responsibility. Sovereignty also means users must protect their own keys and wealth. Why philosophy matters in blockchain. The choices made today will shape the internet, finance, and governance for generations. Blockchain is not just a technical revolution, it is a cultural one. Understanding its ethical dimensions helps guide responsible development and adoption. In the next chapter, we will explore future scenarios and emerging trends, imagining how blockchain and cryptocurrencies might evolve over the next decade. Chapter 18: Future Scenarios and Emerging Trends. Blockchain and cryptocurrency are still in their early stages. The next decade could see explosive growth, dramatic consolidation, or a reimagining of the technology altogether. In this chapter, we explore possible futures and the trends shaping them. Scenario 1: Mainstream integration. In this optimistic future, blockchain technology becomes part of everyday life. Mass adoption. Billions use blockchain-based wallets without even realizing it. Tokenized assets. Real estate, stocks, and intellectual property are routinely traded as tokens. CBDCs plus crypto coexistence. Central bank digital currencies integrate with decentralized networks. Regulatory clarity. Clear, innovation-friendly frameworks attract institutional participation. Scenario 2: Parallel economy. Rather than replacing traditional finance, crypto forms a parallel economy. Decentralized finance grows. Millions rely on DeFi for loans, savings, and insurance. DAOs become common. Online communities coordinate resources without formal corporations. Crypto-native culture thrives. NFTs, gaming, and token-gated communities form a new digital economy. Scenario 3: Fragmentation and bubbles. Crypto markets could experience extreme volatility, leading to speculative booms and busts. Cycles of hype and crashes shake out unsustainable projects. Regulatory crackdowns. Harsh rules push activity into more private, permissionless systems. Multiple chains competing. No single blockchain dominates, leading to a fractured ecosystem. Scenario 4: Co-option and centralization. In a more pessimistic scenario, decentralization gives way to corporate or government control. Centralized gatekeepers. Large companies dominate infrastructure and governance. Surveillance risks. CBDCs become tools of financial monitoring and censorship. Loss of permissionless innovation. Regulation stifles open participation. Scenario 5. Technological leapfrogging. Breakthroughs could enable new possibilities. Scalable blockchains. Networks process millions of transactions per second. Privacy advances. Zero-knowledge proofs allow full confidentiality with compliance. Interoperability solutions. Seamless cross-chain transactions unify the ecosystem. AI plus blockchain synergies. AI models are trained and governed on-chain, enabling verifiable data markets. Emerging trends to watch. Modular blockchains. Specialized layers for execution, settlement, and data availability. Decentralized identity (DID), giving users control over digital identities. Real-world asset (RWA) tokenization, bringing trillions in value on-chain. Green blockchain solutions, eco-friendly consensus mechanisms and carbon offsets. Governance innovation, reputation systems, quadratic voting, and AI-assisted decision-making. The human element. Technology alone does not determine the future, human choices do. Education, governance, and global cooperation will influence whether blockchain becomes a tool for empowerment or control. Preparing for the future. For individuals and businesses, the best approach is to stay informed on technological and regulatory developments. Experiment with new tools to gain hands-on experience. Diversify participation across networks and assets. Advocate for open, inclusive, and privacy-preserving systems. Why future scenarios matter. Thinking about future possibilities helps innovators, investors, and policymakers prepare for both opportunities and risks. The blockchain revolution is still being written, and those who understand its trajectory will be best positioned to shape its outcome. In the next chapter, we will conclude this book with a summary and final reflections, tying together the lessons learned across blockchain's technological, economic, and philosophical dimensions. Chapter 19, Summary and Final Reflections. As we conclude this book, it's clear that blockchain and cryptocurrencies represent one of the most transformative technological innovations of the 21st century. What began as a niche experiment with Bitcoin has evolved into a global movement, reshaping finance, governance, identity, and the Internet itself. Key takeaways. The technology. Blockchain fundamentals. Distributed ledgers, cryptography, and consensus mechanisms provide a secure and transparent way to record transactions. Smart contracts and DApps. These have unlocked decentralized applications and automated trust. Scalability solutions. Layer 1 and Layer 2 approaches are critical for supporting billions of users. The ecosystem. Cryptocurrencies. Bitcoin remains a store of value while thousands of altcoins explore diverse use cases. DeFi, NFTs, and DAOs. These innovations represent new models for finance, digital ownership, and governance. Web3. The vision of a user-owned internet is driving much of the current excitement. The human dimension. Philosophy of decentralization. Blockchain challenges traditional power structures and raises ethical questions about privacy, trust, and governance. Institutional participation. Corporations, governments, and investors are playing an increasingly important role in shaping the ecosystem. Risks and responsibilities. Security, regulation, and education are crucial for safe and sustainable growth. Lessons learned. Decentralization is a spectrum. Total decentralization may not always be practical, but striving for openness and inclusivity is vital. Security is paramount. Trust in blockchain depends on secure code, secure custody, and informed users. Adoption requires usability. Mainstream users will only adopt blockchain when it becomes seamless and intuitive. Regulation can enable or inhibit. Clear, fair rules can encourage innovation, while overly restrictive policies may drive it underground. Looking ahead. The future of blockchain is unwritten, but several themes are likely to define the next decade. Greater interoperability between networks. Mainstream integration of tokenized assets. Continued experimentation with decentralized governance. A growing dialogue between regulators, developers, and users. Final reflections. Blockchain is ultimately about coordination and trust, reimagining how we interact with each other in a digital-first world. It offers a powerful toolset for building systems that are more open, transparent, and fair. But with great power comes great responsibility. Users must educate themselves, developers must code with care, and policymakers must create thoughtful frameworks. Together, these efforts will determine whether blockchain becomes a force for empowerment or control. The journey is just beginning. Whether you are an investor, developer, policymaker, or simply curious, you are part of a historic moment, the reshaping of money, markets, and the internet. Call to action. Learn, experiment, participate, and help shape the future of this technology. Blockchain's potential is not guaranteed. It depends on the choices we make today.